Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Ajay Sharma. And for now, the market is headed to that all-time high level. Remember, we were around 24,175 thereabouts as the earlier all-time high, and now we're very close to that. Even though in the last few minutes we have petered a bit, but nonetheless we have been holding on to 24,100 very, very smartly. A sharp departure from where we started off the trading session. The mid-cap index is steady at that 0.3% gain, but the small-cap index is showing much bigger gain at 1.3%. Gain coming in for that entire universe, and the advanced decline ratio is quite positive. Bank Nifty too has bounced back. It's not a big outperformance or anything, so the pause that we saw on Thursday, Friday continues for the Bank Nifty, but it's not that it's acting like a weak link. Talking about the strong link right now, that's clearly IT. So ahead of the earnings season, there's a momentum there. Perhaps people are looking at those ideas which are underowned. Wipro got a thumbs up from CLSA, a double upgrade coming in from an underperform to an outperform with the stock price, upgrade as well, stock target update as well. So that stock is in focus. Tech Mahindra is high by 3%. We also have Grasim, Ultratech Cement perking up quite a bit in the trading session. From the broader markets, also a lot of names which are buzzing around, but it's Chola Holdings, Garden Reach, JBM Auto, Home First. These are some of the big movers right now. And on the losing side, not many names to be honest, Ajay, but maybe just a India Cements, a Medanta, Torrent Power, far few and between. But yes, there's a bit of red, but largely green on screen.
See, I would say that it's a very good market, and one is getting a sense that FI, I will watch out for the FI voice, number, data very closely today. One is getting a sense that FIs are active today as well. So large cap universe is expanding on the higher side, but mid cap, small cap are not quiet by any feat of imagination. In fact, this is a very vibrant market out there. Largish mid caps, Nifty Junior, BSE 100 names doing phenomenally well. A sense of first quarter numbers, a sense of how the budget perhaps could be a very prudent one fiscally, which FIs and investors generally like a lot. We already seeing how the momentum on the macros is very good. So there's no reason for any wholesale selling. Last week we saw some trimming, some taking some chips off the table, but no wholesale selling, and there isn't a strong case for that. Shivani Sarkar, Korean, is now joining us along with Kunal, who will join us in a minute. Nuresh, of course, is here. Gentlemen and the lady, thanks very much for your time. Shivani, afternoon. Let's start with you. Do you expect first quarter numbers overall to be a strong one, or do you expect the top line to start flickering a bit, because there is a section of the market which believe that FY25 in isolation should be okay, but FY24 versus 25 on numbers may not be a big move?
Yeah, so hi, good afternoon, first of all. So when you look at markets and earnings per se, you're right that FY24 was a great year from an earnings perspective. And if you look at Nifty EPS growth of almost 24%, that is actually higher than what consensus was building in at the start of the year. So overall earnings delivery was extremely strong. Now, on that base, when we look at FY25 and 26, a mid-teen sort of an earnings growth expectation is also strong in the context of the growth that we have come off. So yes, from an absolute number perspective, earnings growth is likely to be mid-teens, but the overall trajectory of growth remains strong. Now, in that context, what you pointed out is correct. The top line growth overall has been muted, and a lot of the earnings has been driven by margin expansion. Now, from here on, the pace of margin expansion vis-a-vis in FY24, FY25 vis-a-vis FY24 should be lower, given the fact that a lot of the benefits that we've seen from commodity prices and input costs have been already seen in FY24. And therefore, you now need to see top line growth come back. And in that context, the revenue growth trajectory becomes important. But having said that, if you look at sectors such as automobiles, industrials, to some extent, even sectors such as banks, the domestic facing sectors, manufacturing, for instance, overall growth trajectory in terms of earnings should remain fairly stable. I think one sector to watch out for will be IT, where earnings expectations are muted as such. And of course, first half for the sector is a seasonally strong segment, and therefore IT is something that we will watch out for. But by and large, most of the domestic facing sectors should be able to deliver fairly strong earnings for FY25.
Okay, so that's a view coming in. IG sector definitely something to watch out for ahead of the earnings season. But let's take the stock of the technicals as well. Nuresh as well as Kunal with us. Kunal, on the IT sector, Shivani is quite positive from the point of view of the fundamentals, and some of that commentary of the brokerage houses will also come up for you on the screen, because quite a few brokerage houses are treating it as glass half full rather than empty. Yes, there has been no material change in the structural story as such, but Bank of America believes that there's going to be fewer instances of incremental cuts to the IT spends. We'll shortly get those lines for you up on the screen. Morgan Stanley believes that second quarter commentary is going to be positive. UBS believes it's going to be more of a tactical trade and not really a structural story. CLSA says that discretionary demand stabilizing is something which is positive. They're expecting no further cut in guidance. JM Financial believes maybe -2 to +2 kind of number is what we see for large caps. But that's the view right now, at least no incremental negative. And that's something we've been calling out for the last couple of quarters as well. But the stocks hadn't done any better. This time around, is it different, Kunal?
It's very much different, Anisha. So just to give you a context, last month we were 7,000 points away from a life high for the IT index. Right now we're just 1,500 points away, from the IT index to hit a lifetime high at 38,500 plus mark on the spot levels, which means that this last 1 month there has been a very good recovery for the Nifty IT index, and it's been led by large cap names. And apparently it's not the likes of TCS which has done the major heavyweight in terms of price gains, but you have the other stocks, the likes of Tech Mahindra, which has done pretty well. You've seen Wipro doing exceptionally well, more than a 15 to 20% jump in the last 1 to 2 weeks alone. HCL Tech has done remarkably well. The mid-cap IT stocks have been quite strong. In fact, many of the mid-cap IT names are coming back from a divergence of 15-20% below their 200 moving averages to now break past about those levels, and even some of them have even rallied above their 200 DMA. So that's a very steep kind of an outperformance which has come back. And historically we've seen that whenever the IT index or any kind of an index, when it recovers more than 50% to 60% of a major corrective wave, the worst seems to be out, and then the indices or the asset classes look out for a retest of the previous high. So I would believe that potentially over the next 1 to 3 months, you should see 38,500 being scaled for the Nifty IT index.
Okay, 38,500. So solid almost 2,000 point rally on the cards for our IT sector. But what about the auto sector? Because the June data has come in more positive than negative. The expectations were muted. So yes, the downside was limited, but at least they managed to surprise a bit. Naresh, from the auto vertical, anything that stands out?
So in terms of autos, one name which I'll be putting close on radar is Tata Motors. The stock, after making that top around 1,050, has made a range between, say, 930 on the downside, 1,030 on the upside. So once it crosses that, that would be a short-term breakout. The other names have already done well, so waiting for a dip rather than buying at current levels. The momentum has been strong across the board. Maybe a Maruti would still come into picture because it's given a reversal today from the 12,000 mark. That could slowly scale up towards 13,000 again. But the most interesting name going forward could be Tata Motors.
Right. Shibani, I want to talk about some late stage cyclicals from the real estate space. Look at how this Kajaria has actually come back. If I could for reference sake tell you, the long-term chart of Kajaria, it is actually crossing the levels, its previous life levels at 1265 odd. So, and this has come back after 3-4 years gap. It coincides very interestingly to the commentary the management made previous quarter that perhaps worst is getting over, and they being the leader of the tile perhaps is actually calling out the sector reversal. How do you look at the valuations of the tile space? Kajaria perhaps is the only one very serious right now, maybe Somani among the funds fraternity, but there are smaller ones. How do you see Kajaria or this sector, Shibani, or this space?
Absolutely. So if you look at the entire building materials segment and specifically the tiles piece, this sector has actually underperformed despite the fact that you've seen significant growth where real estate is concerned. Now, what we believe is that when you have real estate sales pick up in a big way, the demand and the volume growth for the building materials sector usually follows with the lag. Now, this has also been a sector where you've seen the organized players gain market share over a period of time, so that unorganized to organized segment shift has also been seen. And as the overall real estate sales translate into a later stage where you start doing your interiors, etc., that's when the demand starts for segments such as tiles and other parts of the building materials piece. And therefore, while volume growth has been muted in the last few years, and that has impacted the stock price performance, we do expect that now, given the strong momentum on the real estate side, the overall volume growth start to pick up. Now, in this sector, we've also seen that margins have improved because of lower input cost pressures. And as volume growth picks up, the operating leverage will also help in terms of driving margin improvement further. And therefore, from the overall real estate space and building material segment, valuations in the building material space today appear to be far more favorable than what it has been for the real estate space, given the kind of sharp run up that you've seen on the developer side. And hence, in pockets of building materials, we are fairly positive given our expectations of improvement of growth and fairly reasonable valuation.
Okay, point taken. So that's about some of the real estate and building material plays. But Kunal, what's happening to the likes of MGL and Castrol? MGL has been doing quite well for itself for the last 3 to 4 trading sessions. Today up 8% and on good amount of volumes, one would say.
Yeah, in fact, last 2 days the stock has seen a very strong set of volumes, and you look at the price action. So earlier, you look at the last 4-5 days also, the volumes were a lot more, smaller for MGL, and the price action was also limited or constrained into a range. But the moment you've seen the volumes moving up higher, the stocks have done exceptionally well. It's a classical case of a breakout, a price volume breakout. 1600 levels was the previous resistance for MGL, and that was in the month of February. So which means after a span of almost 4 to 5 months, the stocks have given a breakout, and this could potentially be an up move candidate for at least another 8 to 10% higher from current levels, which means 1850 approximately could be a target range for MGL. Castrol, on the other hand, is something very interesting. This is something which I have been tracking over the last 1 to 2 weeks, and especially from the point when the stock had come back above its 200-day moving average. I think that was around 192, 194 mark for Castrol. And then post that, the stock had seen a gradual uptrend, slight increase in volumes, but today's price move indicates that the stock is getting ready for a breakout yet again. So this consistent propensity of the stock to try and come back into a resistance breakout, I think eventually would lead into the stock breaking up higher and moving up into a fresh uptrend. So looks attractive for a potential target of 230 approximately.
Okay, so both Castrol as well as MGL look quite interesting. Before I take it across to Somit, who will be joining us shortly, a quick word from you, Shubhani, on the entire oil and gas space, because one would have assumed that, even the other OMCs had run up quite a bit, but clearly, at least in some of them, there is still value on the table.
So absolutely, if you look at the entire sector, valuations are quite favorable. In terms of oil prices, our view is that prices would be fairly range bound. Of course, if there is any geopolitical tension that comes through, that is something that would have an impact. But as of now, we do expect that oil prices would remain fairly in a range. Now, where we have looked at, if you look at the entire portfolio and the segment, our allocation prefers spaces on the gas transmission and utility companies where there is significant scope for volume growth. As it is, if you look at in terms of the entire energy basket, the share of natural gas has been increasing, and therefore structurally this is a segment that we are positive on. On the OMC side, you are right. There has been some degree of volatility where, at least on the refining side, but marketing margins continue to hold up well. And if oil prices stay within a particular band and remain range bound, valuations do appear to be fairly reasonable.
Point taken. But Somit is now with us. Somit, help us understand what's going on with MGL. Last couple of days, that stock has been on fire.
Well, yes, MGL remains the stock in focus. The stock has been gaining for the last 5 consecutive sessions. It is at an all-time high. Today's intraday move is the highest intraday move that we have seen since November 2020 in the last 5 sessions. The stock is up nearly 17% and for a very brief period of time today in trade, if you see, the share prices of MGL were even above the highest target price on the street of around 1,730. But some time back, Citi came out with a recent note on MGL which in which they have actually increased the target price to 1,859 from 1,550, and they have maintained their buy rating on the stock. Now, the reason behind the rise in target price was just a change in the cost of capital assumption. They are also mentioning that fundamentally and financially nothing has changed in their assumptions when it comes to Mahanagar Gas. Now, for first quarter, analysts are expecting a double-digit volume growth from the company, around 11 to 13 odd %, but that is also because of a low CNG volumes in the base quarter. So nothing has financially or fundamentally changed for Mahanagar Gas currently. Also in the recent meetings, if you see, in which they met multiple investors in the US market, they were kind of optimistic about higher volume growth going forward. They're expecting volume CAGR of around 6 to 7 odd % versus historical numbers of around 5 to 6%. They're expecting EBITDA margins to be around 11 rupees per SCM for the near term and around 10 rupees per SCM for the medium term. And they're also saying that there are multiple positive policy announcements that could come in, but however they are also uncertain on the timing of that going forward. So all in all, nothing has changed fundamentally or financially for MGL. It could be a technical move on the share price that we are seeing for the last couple of days for Mahanagar Gas.
Shibani, I wanted to listen to this small slice of the conversation we had with the Shree Cement earlier in the day, clearly spelling out that yes, they are looking for buyouts, but they would go for smaller, fiscally prudent buyouts, if I may call it. They will not go for overpaying, for large inorganic kind of moves. And then we come back and discuss the cement space. But hear out what Mr. H.M. Bangur had to say about buyouts. They are not averse from it, but they would not overpay. They would be very thoughtful about what they are buying.
We are totally geared up for 80 million ton organically. Inorganic growth, we will be looking at it, but not very aggressively. If something comes up which is of right size and meets our overall demand, overall expectation and overall scheme of things where we want to be in 5 years later, then only we will look at it. We will be targeting only something like 3 to 5 million ton with smaller companies.
Star Health, which is gaining almost 3% in trade, and also Religare Enterprises, where two stories are panning out. Look at that, days high, 3%. Religare won by 12th of July as per SEBI. The Burmans have to launch an open offer, but above that, there is also an angle of Max Bupa here. Both are health insurance. This one houses Care Health, Star Health, of course, we all know. And when Max Bupa is filed for IPO, these two stocks are suddenly buzzing in trade. But we were talking about cement space and potential smaller companies. Shibani, where do you see value? For example, I mean, there are stocks which are at over $100 a ton in the same space, like Ultratech and many others. Then there is a Mangalam, which is at $25 a ton. This valuation gap, do you see this narrow going forward in cement space, and where will the money flow, to mid-tier or the larger ones?
So in the cement sector, this is a sector where consolidation has clearly been the the flavor of the day. Now, this consolidation we believe will continue. So if you look at the way the market share has panned out for the top 4-5 players, we've seen consistent improvement in market share, and therefore in this context, the larger companies seem to be clearly well placed, and this market share gain is possibly likely to continue. Now, because of this consolidation and M&A that we have seen, the smaller players have almost become marginal. So there has been huge amount of capacity addition that has taken place by the larger cement companies, plus the M&A activity that is going on within the sector. Now, from an overall sector perspective, one, we believe that demand remains fairly intact, both because of investment-led growth as well as real estate, which is showing up in terms of volumes being fairly strong and stable, despite the fact that we are now in the monsoon season, where typically activity comes off. The key factor incrementally for the sector will be pricing. Now, while demand has been strong and we have seen consolidation in the sector, pricing actions have been somewhat muted, and many companies have not taken price hikes or have not been able to sustain price hikes for a period of time. But this also comes at a point where input costs are fairly benign, and therefore, from a margin perspective, with volume growth being strong and input costs being benign, margins are holding up well. For the sector, in terms of profitability, pricing is key. And what we believe is that if you take a slightly longer term view, with consolidation in the space, pricing should also follow through, and therefore profitability should improve. But net net, we do believe that the larger players are well placed because of the kind of market share shifts that we have seen and the M&A activity in the space.
Okay, point taken. So that's the view coming in as far as cement is concerned and the consolidation that we are seeing across the board in that sector. In terms of some of the other buzzes in the trading session, in the last few minutes, KRBL has seen a bit of a perk up. Patanjali Foods is in focus. You also have Chalet Hotels, which has managed to perk up a bit in the last few minutes. And overall, Home First Finance has also been doing quite well for itself, and ditto can be said for JSW Infrastructure. Naresh, a view on some of these names, Home First Finance as well as JSW Infrastructure?
So Home First Finance, starting with the stock has been sideways for a long period of time. If you look at it, the previous high was around 1050 odd levels in end of the year as well as start of it. Then 2022, roughly the stop was around 1000. So finally, the stock has broken out about those 1050 levels after being sideways. The only concern is it has moved up from 800, 850 where it was just a month back. So the risk reward may not be as great, but one could actually keep a stop loss at 1000 and still be long on the stock from here on.
All right. Shivani, we'll let you go on that one. Thanks so much for joining us on the show today. But Jay Kale, Senior Vice President at Elara Capital, who tracks the auto space very closely, is now joining us. A lot of news flow around autos, Jay. The numbers, the monthly numbers are flowing in. Ola Electric IPO is round the corner. Let's start with Ola Electric. Have you looked at the RHP number yet, or data which has been posted in the public domain?
Yes, I mean, they've given their financials, of course, till Q1 FY24 on the financial side in the DRHP, in the RHP. So over there, I think, the market share wise, they've ramped up pretty well. One needs to see the sustenance of that market share with the other OEMs also ramping up their capacities as well as distribution network. I think the profitability, of course, as expected, is weaker currently. With PLI benefits and with the aggressive pricing that they have had in the recent past, their profitability will be keenly watched because EV volumes, if you see, have still held up well in June. If you see the penetration levels are at around 5.8%, which is largely in line with our estimates. So going forward with the ramp up of other competition on their capacity as well as distribution network, as well as the aggressive pricing of Ola Electric, how sustainable this is in light of the profitability in their disclosed numbers will be a key thing to watch out for on how sustainable these market share gains are.
Okay, so that's about Ola IPO just around the corner perhaps. The other one, of course, is Hyundai, which is also expected soon. But before I get to Hyundai, Jay, wanted your take regarding the auto sales data that has come in so far. Looks like by and large, it's a beat coming versus the expectations, especially on the likes of Bajaj Auto, where there is a bit of recovery. Even the likes of Atul Auto, Maruti Suzuki, decent set coming in from those, right?
Yeah, I mean, if you see two-wheelers as a pack, if you see even the retail sales for which the entire industry numbers are out on the Vahan retail sales, they have grown at a decent 4 to 5%. And even if you see a block of March to June, they are tracking that close to 10% on retail growth, which is largely in line with our FY25 growth estimate of 9%. In terms of wholesales, of course, there is this portion of exports coming in a little higher than estimate. Both for Bajaj as well as Maruti, whereas domestic sales were largely in line with estimates. But as an industry, if I have to look at, two-wheelers is holding up much better than passenger vehicles, where we've seen some bit of pain in the last 2-3 months, with inventories also rising in the passenger vehicle industry. And two-wheelers in terms of retail growth has been much better off. So it will be keenly watched how the inventory is managed by the passenger vehicle players. And if retail sales picks up, especially after the last 2-3 months have been marred by the elections as well as the heat wave, etc., how monsoon plays out and how the entry-level buyer comes back will be keenly monitored for passenger vehicle industry.
Jay, what did you make of the numbers for Eicher Motors. Appears slightly higher. Also Leyland versus Escorts. Essentially, I want to talk to you about how the numbers are pairing in for your CV end of the cycle, and what is the sense you're making? Are we in a recovery mode in the second half for CV cycle?
I think in the CV cycle, of course, from a tonnage wise, if you see, we've already crossed the tonnage peaks of FY19 and FY23 itself, and FY24 was much higher. From a volume side, if you see, last 2 months was a growth on a low base of last year, because last year had seen a big pre-buy in March, and hence April, May was relatively lower. So on a low base, you're seeing some bit of growth in the first 2-3 months of the fiscal. For the full year, our growth estimate is still at around 3-4% odd growth. Second half is expected to be better with, because the government's just been formed, the infrastructure activity in the monsoons is not expected to pick up pace, and which will pick up pace only in the second half from October onwards. So growth is expected to be much better in the second half. What will be interesting to see is the profitability. I think this time around, the industry is much more disciplined in terms of their pricing in the market, and hence the margins have been better than estimate. But our view is that we are largely towards the peak of the cycle, and one needs to be very cautious on because when you're near the peak of the cycle, the incremental growth rate may not be as high as what we could get in a passenger vehicle or a two-wheeler industry as such.
That's a word coming in near to the peak of the cycle, but would you call it the same for the stock prices as well? Are we near the peak already for a lot of these names? 2024 was a solid run, and 2023 was a solid run, and so far in 2024 it hasn't been bad at all.
Yeah, I mean, autos has seen a stellar run. We've seen in Q4 a lot of earnings getting upgrades for OEMs. We think that the large part of the OEM upgrades in terms of earnings is behind us. Q1 will be keenly watched. There could be some OEMs who could see some downgrades, some OEMs retaining the numbers. A large part of the upgrades in the earnings cycle, in our view, is behind us, and then it will be mainly stock selective. It may not have a sector run as such as what we had seen in the last 8 to 10 months. It will be clearly stock specific outperformance and underperformance that one would want to track from here on, purely basis your earnings cuts and earnings upgrades that we will see.
We saw, kind of while everybody was very excited about, I'm talking about 6 to 8 months back, when TVS was around 1,000 rupees, 1,100 odd, everybody got very excited about this Ola Electric IPO and all of that. But actually the big move came in, if you can pull up the charts for last 1 year, in TVS, in Bajaj and Hero, because the legacy guys also had by the time Ola Electric became large or Ather became large, they had kind of developed their own some part of the EV two-wheeler business reasonably sized, and hence a value unlocking. Is that trade over now? Are these fair prices for most of the two-wheeler companies, pricing in both ends, legacy as well as EV part of the business, or some more room for re-rating?
Yeah, I think a large part of that has played out for the two-wheeler names. But if you see the overall volume growth momentum is still pretty resilient for the two-wheeler industry versus even a passenger vehicle or a commercial vehicle industry. And within that, we would like to be in names who have structural levers of market share gains as well as margin increase. And which will give a very strong earnings growth. So one of them, of course, is TVS, second being Bajaj. So it's something, where valuations, yes, have been expensive relative to their historical valuations, but that has been the case for a large part of the market participants. So, we would still like to place our bets on companies which has a macro tailwind of earnings of volume growth for the industry outpacing the other segments. And in certain cases within that segments, companies who have levers of margin expansion as well. And, TVS seems to be one of them. So we would still have an outperformer rating on TVS.
Okay, so still positive towards TVS Motors. Thanks, Jay, for making time and speaking with us regarding a whole host of issues which are at play for the auto sector. Time now to head into a very short break, but don't go anywhere. On the other side, we'll decode a big exclusive that we are picking up as far as the power sector is concerned, and what could be in store in the union budget, which is expected just 20-25 days out with respect to transmission as well as the power sector. We'll decode that with Anand Tandon as well, who will be joining us very shortly. welcome back. Just taking a quick stock of what's happening across the globe. The European markets have opened very well. Remember, the French CAC was reacting to the election results, or the exit polls of sorts from the French region. So that's something to watch out for. That index is up 1.25%. You also have FTSE MIB up. So Italy is also opened up with a bit of a gap up. And for now, the pre-market rates from US are also suggesting a bit of a green on the screen. But back home, it is all about union budget that we have our eyes on, and this time around, there could be a big announcement on the anvil for the power sector. What exactly could it be, and what shape and form it's likely to take? Prakash is joining us with those exclusive stories. Prakash, it's a very interesting scoop that you've picked up for us. Tell us the details of how it will impact the sector. What kind of outlay do they have in mind?
Yes, we are learning from our associate that the government is likely to announce a new scheme for the power sector in the upcoming budget. We are given to understand that the Power Ministry has prepared a proposal which has been sent to the Ministry of Finance for its approval. A new scheme called Janman, which has been designed for electrification of leftover households across the country. Under this scheme, around 5 lakhs households are going to be covered, and the sources are informing that the government is likely to provide around rupees 2,500 to 3,000 crore under this scheme. Along with that, the primary vulnerable tribal groups will be the focus under this scheme, and the tribal households in the states like Rajasthan, Uttar Pradesh, Andhra Pradesh will be covered. Along with that, REC is likely to be the biggest beneficiary. In addition to that, the sources are also informing that the government is likely to provide additional financial assistance to the DISCOMs to bring down their overall AT&C losses below 15%.
Now, power clearly has been one area where a lot of work has been done. Biggest multi-baggers, be it transformers, be it wires and cables, power generation companies, and it appears that it remains a big work in progress, and the focus will very well continue. Anand Tandon is also joining us on the discussion. Anand, you may have heard my colleague's report, which he filed at this budget too. There's a lot of stuff coming in out there. How do you see the power sector from the market standpoint? Because while so much is happening, market usually tend to kind of move ahead of itself and factors a lot of things, in present terms already. Has that happened here in power sector, or you see more juice here?
Well, there are two ways of looking at it. One is from the demand point of view. Clearly, demand is going to keep on going up. We had a period about 4-5 years ago where there was some subdued demand coming through, and there were overcapacities in terms of generation. That is now behind us by a wide margin. In fact, there is need for further investment in that sector. To that extent, we have seen some revival in terms of announcements of new plants coming through, especially thermal power plants, because of the fact that renewable is not enough for you to be able to continue to grow to meet the demand that is likely to come through. In terms of the pricing of power, that is where the challenge is, and no matter whatever the government has done so far, it has not been enough for the simple reason that the political exigencies of having to give away free power is so much, and despite having the requirement that they should be funded by the state government's budgets, it just doesn't happen. So almost all or a large number of distribution companies continue to remain, terribly cash strapped, and that affects the entire payment cycle. The new plan that you are talking about will help to some extent in terms of ensuring that there will be some notional connectivity to all the remaining households, which should not have been there in the first place, but even then, and therefore to that extent, some amount of equipment will likely get sold. But in terms of the actual demand, unless you again provide them power for free, it can be like the Ujjwala Yojana, where you may have provided them gas cookers, but the gas prices are so much that many of these households are not in a position to use it. Net, from a stock market perspective, I don't see a major upside from any of this, other than the fact that the market is in euphoric territory, so all news is good news.
Coming in on the power sector, Harry Dole also joins us on the show. He's of course been a big watcher of the entire power sector and currently he's the Director General of Independent Power Producers of India Association. Harry, hi, good to be speaking with you. What do you make of this big announcement? If it does happen in the budget, they are talking about electrifying leftover households, could be a financial assistance of around 2,500 to 3,000 odd crores. Which to your mind are the key beneficiaries of this and what exactly is the ask of the power sector from this union budget?
Well, I think it's extremely good and important to understand that everybody in this country has a right to access power for their safety, security, for various other requirements of living. I think power has become a lifeline for people, whether they are in rural or urban environments and so on. This is a good scheme. It's a good step forward, but I think it's a very small step. And I think in times to come, listening to your previous speaker, I think what's going to happen is that all these guys are going to become surplus and will not be customers of the distribution companies because they'll all turn to solar and other renewable energy sources, either on their rooftop or on their balconies or wherever. And that's where the government should subsidize and finance, if I may say so, the DISCOMs to make sure that these consumers are off-grid but are 100% connected to the grid by way of renewable energy. That's the first point. The second point is this whole beaten track that distribution companies don't have enough money because of political consideration. This is a very old story. I've been hearing it for about 25 years now. But I think this will pass now with the use of technology and the use of the new efficient renewable energy options available, where you are going to get a revolution happening, technologically speaking, where people will become independent of the grid. So I think this whole concept of the grid weighing down on the power sector, I think will be something of the past, and I hope it happens soon. Last point, demand calculations, just in the state of Karnataka, last year we had a 10,000 megawatt demand and it shot up to almost 18,000 within 1 year, an 80% increase. That means there is a lot of suppressed demand right now which is not coming up, and therefore there's a huge upside for the power sector in the years to come, both on the supply, equipment, and whatever side you want to call it, as far as the power sector is concerned. I'm very, very positive about it, and I think it's a damn good step the government has taken, although it looks like a small step, but it's important that everybody has access to power.
Right. All right, Harry, thanks very much for joining us on the show today. Let's go across to my colleague Ansh now to talk about which are the biggest movers, volume buzzers of the day. Ansh?
Right, so Oracle Financial will be the first stock in focus for today's session as the stock has given a breakout from its 10-session consolidation pattern. In addition to that, the stock has also touched record high level, and the breakout is backed by heavy volume of around 3 times its average trading volume of last 10 sessions. Apart from this, Persistent will also be in focus as the stock has surpassed above its key pivot high of around 4,450 level, touching record high level, and the stock has also registered its biggest single session gain in over a year. Also, the breakout, the surpassing, has been backed by good volume of over 2 times its average trading volume of last 10 sessions. Lastly, REC will be in focus as the stock has given a breakout from its 14-session consolidation pattern, hitting 4-week high with good volume of around 40% of its 10-session average volume. So keep an eye on the stocks.
Some big price volume buzzers right now, but Anand, what's the view on PVR? It's become one of those stocks which is just clearly associated with one movie release versus another, because other than that we haven't seen a big pipeline. Today of course the stock is reacting to Kalki's numbers and we'll run those for you on the screen, but what's the take on the stock?
Well, clearly it depends on the content that is available, and the content pipeline right now looks fairly decent, because if you look at the number of launches that are lined up for the next few quarters, it does appear this year may be a little better than what we've seen in the recent past. More importantly, even the Western movies which were out of fashion or were not being produced last year because of a strike in Hollywood are likely to come back again this year. So to that extent, again, you will have a better pipeline. Good pipeline means greater possibility of some hits. And obviously, the local F&B as well picks up if people actually come into the cinema. So generally, I think from a tactical perspective, this would be a place where, from here on, the business outlook for PBR should be significantly better, at least for the next 12 months. But each month has to be watched separately because it all depends on the content that's coming in and how the audiences react to it.
Sandeep, Anand, where exactly are you finding value in this market? How are you approaching your portfolio? I mean, have you raised some cash lately, or are you running positions which you made early entry into but not buying anything new?
So there is no value in the market. Let us be clear on it. We are in a momentum market, and therefore you have to really see where is a growth possibility which will allow you to catch up with value, even assuming that in the best case the stocks don't fall. And therefore you are looking for stocks which have a more or less defined growth trajectory, which brings you to many of the cyclicals actually, because it would appear to me that, for example, one of the key themes was last year most of the commodity prices were down. That is now have been played out, and from here on you would expect to see commodity prices rise all over again, especially energy. And therefore, things like oil and we've already seen that happen with many of the softer commodities, the agro commodities, and as well as the some of the, as I said, energy and so on. So I think you will find that many of those industries which are dependent on that will actually do reasonably well. Margins, obviously, for many of the consumers will be under pressure, and therefore that's an issue. You are really searching for places where there is going to be greater government action, where you are sure that there will be spend going through, and therefore companies can benefit. And from that perspective, again, if you see the kind of stocks that are moving up, they are pretty much, again, kind of anchored towards government expenditure, whether it is rural demand, whether it is infrastructure, or whether it is capex-oriented companies. There are very few sectors which have genuine upside potential without and being significantly cheap. For example, the run that we are seeing today in things like IT are more out of hope than out of any strategy. But the places where there are significant changes in regulations, for example, today the fact that over the period that SEBI has now decided that they will allow easier delisting of holding companies. I would argue that holding companies discount may likely be occurring, and therefore may narrow, and therefore you might want to look at holding companies as part of your portfolio, at least in a small way. Don't go overboard on it simply because there is no immediate trigger for any of the companies to do anything. But the fact that you are buying it at a discount and there is now a regulation which allows them to delist or to move out with less of a discount gives you some potential of downside protection. So it's pretty much tactical and trying to figure out wherever you think there is less chances of volatility downwards and greater chance of at least a stable earnings going forward.
Taken. So that's the view coming in. There's no value on the table right now. It's all about momentum, and the momentum right now is on the upside, 24,150. In the last 2 minutes, some of these PSUs have actually moved up. BAML, HAL, BHEL, these are some of the names which in the last 2 minutes, even BDL for that matter. So some of these defense names are on the rise. Take a look at those big upswings which are happening across the board. So I'm talking about Bharat Dynamics, Hindustan Aeronautics, you have Bharat Electronics, you also have BHEL, Bharat Heavy Electronics. So all of these names are something which are actually in focus right now and perking up. But separately, I also wanted to put the spotlight on the stocks and news, and let's pull up some of those names which are actually buzzing around. On brokerage action, L&T is up 5%. UBS initiated coverage on that counter with a buy rating and a target price of 230. That will come up for you on the screen. Wipro is the other one that we have been highlighting, up 3% after CLSA double upgraded the stock to an outperform from an underperform earlier. GB Pharma is in focus on account of that Kotak security initiation happening. Target price above that 2,000 rupee mark. Garden Reach is locked in upper circuit. That $21 million order, which is just 175 crore. That's only the trigger point, but that stock is definitely locked in upper circuit. You have updates coming in on REC, IREDA in terms of the Q1 updates. REC, the loan sanctioned is up 27%, and for IREDA, that loan sanctioned amount is up 3x on a year-on-year basis. Of course, we spoke with the management of IREDA as well, and we'll quickly play out a soundbite as to what's happening in that business, because the management was fairly confident that they're on their growth path and they are working to cut down their asset quality issues as well. Listen into a slice of the conversation we had with the management of IREDA earlier in the day.
we are expecting that probably now that is in advanced stage, and they will take a final call on this. Along with us, also I came to know Utco had also submitted their request. If we get, so in addition to PFC, REC will be another 2 agencies. So we can go to market and we can raise from the market, assuming it is 5.25 or even 5.5. Today we are raising from the market at 7.5, 7.4, something like that, because 1 week back we raised around 1,500 crore for 10 years, and it was 7.42. So against that, if it is 5.2, so almost 150 to 200 bips difference will be there. And if we pass on that to the sector, remember one thing: the new and emerging sector, the challenges are more. So when challenges are more, we load that risk factor to the interest. So many projects which are not becoming bankable today because of that loading, if we have a cheaper source of borrowing, then that much can be passed on to the sector, and the project which are not becoming bankable today, those will become bankable. And that will further speed up this 500 gigawatt target in the country.
Anand, any part of the PSU pack where you see value, or bulk of the stories are already in the price?
I think of them, and I look at sectors from a traditional, which industry are they operating in. It just happens that some of those are more dominant where government is more dominant, and somewhere they are not. So clearly in India, defense is largely dominated by the PSUs because of historical factors. And though that is changing, it is a very slow change and is likely to remain slow for some time. So, for example, defense, we want to continue to be there. Absolutely. Would you think that, there is, are you going to make dramatic money from here on? Maybe not, but at least you are sure that the amount of spend is not going to drop off. More importantly, because we have started exporting, there is a greater chance that you will have a little bit of diversity in terms of being able to sell, even if India itself is not purchasing that particular platform. So that's certainly a place. Again, as I mentioned, energy, I think I'm quite bullish actually on what the outlook for oil is likely to be. And therefore, obviously upstream exploration companies would have been a good place. But unfortunately in India, because of the fact that we have a windfall tax that is imposed on the upstream companies, that prevents them from actually passing on the benefits to shareholders. So while there is a space there, it is not easy for you to access it if you're looking at only Indian investments. For the rest of the sectors, unless there is a monopoly, government doesn't do very well, right? I mean, we are clear that in any place where the government is actually competing with other players, they make a mess of things. And that is likely to continue. So I think you have to be very selective about where you want to be vis-a-vis the government ownership, simply because of the fact that it is public ownership, which means it is owned by nobody.
That was quite brutal actually, if you heard that answer. But that's Anand for you. He always gives it.
Calling a spade,
clearly.
right? So that's the situation of the Indian defense sector, and a lot of public sector entities are not shying away from calling that. But in the meantime, let me take the BTSC ideas from our technical experts. Naresh, what's on the buy today, sell tomorrow list? Okay, we'll take that, those, recommendations up on the screen. So Bajaj Finance was one of the recommendation that Naresh has, and let's see if there is any other, because he's recommending a target of 7,400 there. The other one is ACC, where he has a buy stance with a target of around 2,770. Kunal, what about you? What are your recommendations on the BTSC trades?
Tata Motors is something which I think has confirmed a breakout about the 1,000 mark today. So suggest a buy with a target of 1,040 and stop loss at 980. And ITC apparently is also another name which is making a comeback. It's still trading below its long-term averages, but the volume patterns, the intraday indicators suggest that this could be a start of a potential breakout move for ITC. So would suggest a buy with a target of 460, stop loss at 415.
In the last few minutes, MGL has finally got locked in the upper circuit now. So it's 10% as far as the cash market is concerned. You also have up move on Policy Bazaar in the last few minutes. Let's pull up that one, and 361. That stock has been on an amazing tear on the last 7 to 10 days. Naresh, if you're back with us, a view on Policy Bazaar as well as 361.
So PV Fintech has been the first one of the block in the whole new age space. The trend continues to be strong. Even today, the stock has given a fresh breakout, and more interestingly, it's crossed the IPO highs, which is where it was listed around that 1400, 1450 mark. So it was still a very positive chart here. 361 in the short term could take a pause. It spiked from those 850 levels just a few days back to almost 950 to 1050 zones. So expecting a pause over there as such.
I mean that 361. There is a slew of some new joinees out there, which is keeping people
Very marquee
pretty
new joinees that all of us watch out for. So
Does
Ruchir
it
Sharma
impact
has
the
come.
business? Yes,
No,
Ruchir
of
Sharma has
course,
come.
it doesn't impact the business, I think, on a day-to-day basis, but I think that's just one of the trigger points that we are talking about. It's not the kind of business where that leadership matters as a banking name, like SBI is getting a change.
And guess also what? I mean, he's joining as a
Advisory role.
an allocator, right?
Yeah.
But 361 is all about collection, because they have some 3,000, 5,000 biggest HNIs of our country as their clients, and the collection and the kind of flows they have is amazing. Anand, any of these market sensitive kind of names which you like, either the distributors or asset managers, even some of the platform companies, K-Fintech or scams, etc. Anything out there which you like for the long term?
I think that business segment is fairly interesting. Clearly, as India goes more towards from savers to investors, you will have more money coming into that place. The only problem is that this is a cyclical business, much as we may want to ignore the fact that there has been no cyclicality over the last decade or so, and therefore think of it as a secular growth. The reality is that people come into the market in droves and they go out in droves, and for a long period of time, you may find that there is nobody there. Now, the question is whether that has permanently turned. I don't believe anything is permanently changed. Consequently, I would be worried at buying at the top of the cycle. So, will you continue to see growth? Yes. Will you continue to see money being made from the market from these companies? Not necessarily, because they don't really have too many modes where, if you are distributors, etc., where you can really add too much value. The asset managers are a very interesting place, but again, the same challenge that they are extremely expensive. You only have to look at what asset managers trade at globally to see that Indian asset managers are growing perhaps in the maybe a little marginally better, but otherwise growing at the same rate as international players and trading at 3 or 4 times the valuation of the international players. The places, therefore, that I would be more sanguine about investing continues to remain boring places like banks and insurance companies. Insurance, because once you're locked in for life or almost for life. Banks, because you have no option but to deal with them, even though they may be very usurious. Therefore, net, those are the more safer places where, despite whatever quality of service you get from any of them, you may continue to have to deal with them, and that makes for a very good investment.
Positive on insurance and banking names, but nonetheless do like some of these broking and the stock market ancillaries as well. But talking about stock market ancillaries, names like CAMS and K-Fintech have been in focus and on investor radars. We did speak with the managements to understand the way forward. Listen into a bite of that conversation.
Blended at company level, EBITDA margins are at about 45% now, and historically, if you see the last 4 years, they've grown by about 1% every year. Our expectation is that growth, that margin expansion in the EBITDA line of about 1% every year will continue for the next 3 to 4 years. There's a strong possibility. It is aided by the core business, which continues to scale. It is also aided by revenue build out in the non-MF businesses, where we are kind of ending the cycle where we were investing in platforms. So the platforms are built, and now whatever cost it takes to build out the go-to-market, that will continue. But we expect non-MF, revenue contribution, like I said, to be in the range of 30% annually. For overall margins at company level to expand by about 1% on the EBITDA line every year for the next 2 to 3 years. On a longer scale, on a 3 to 4 year scale, we expect to be growing revenue about 15 to 16% in a sustained manner. Of course, market tailwinds and a lot that happens in the capital markets will continue to impinge upon how we grow, but at a broad level, you could think of a 15 to 16% revenue growth in the next 4 years.
There is the opportunity, and hence, we should always chase it. We should always be in an addressable market, which is quite substantial. But at the same time, one of the other reasons why we ventured into global is to de-risk. Now, as a professional entity, it is our duty and responsibility to de-risk. Now, we always believed and continue to believe that mutual funds and India is a phenomenal story for the next bunch of decades. That said, this is financial services industry nevertheless, and we will always hit the cyclicalities associated with that. There can be market turbulence which can impact businesses like us. So for us, it's a huge amount of risk mitigation strategy as well, as we cut across multiple other asset classes and into multiple geographies. We have, in 2018, acquired the transfer agency arm of fund administrator in Malaysia, and that is how the sojourn of international business started. And with that acquisition, we got 2 clients and negligible amount of revenue. From that, today, we scale it up to roughly about 10% of my total revenue pool, which is almost $10 million of revenue comes from my international business today, right? And this had been growing, obviously on a 5-year basis, $0 to $10 million. It is not percentages. You're really talking about growing in multiples, and that is how a young business such as this should. The addressable market of Asia, where we are currently present, is roughly about $9 trillion, of which major chunk is in Singapore. The rest of all markets together is probably about $1 trillion. We have just taken baby steps to start Singapore. We have created a first office platform called Exalt, and we're moving to Singapore soon enough.
Okay, so those are some of those stock market ancillaries which are expected to do quite well. And if you want to listen into a larger part of that conversation, you can of course tune into any of our social media platforms and you'll find those conversations quite engaging. But what's also engaging our bandwidth right now is the market mood, and some of the stocks like a Castrol, a Chalet Hotel actually in the last few minutes has managed to perk up 8%. Shyam Metallics, JBM Auto, these are some of your big gainers right now, and Vedanta too has managed to see some amount of perk up. But let me just quickly talk about what else is happening in the market and overall tell you what are the other data points to watch out for the trading session tomorrow as well, because we understand that the JOLTS data will be out, the jobs data that is in the US, CDSL board meetings tomorrow to mull a bonus issue, Bajaj consumer buyback might start tomorrow, there's Oil India too, which is going to trade X bonus in the ratio 1:2, and Allied Blenders and Distilleries will also list on the bosses come tomorrow. On the losing side, quickly pull up Thermax. There's a bit of a pressure on that stock in the last few minutes, so just watching out for what's happening there as well. Quickly, let me actually toss it across to Winnie to get the market closing as well. Winnie, overall it's not been a bad day at all for the bulls. We have been in the green for most part of the trading session, but which are the big buses that we saw in the trade today?
Absolutely, we will be closing this Monday on a positive note, or not a bad start for the week that we're seeing coming in for the markets. And Nifty will be closing about the 24,100 mark. 139 is where we're seeing the close at, up 0.5% in trade. Sensex 2 is closing with gains of almost 0.5%, 79,470 coming in for the Sensex as well. Nifty Bank performing exactly this time with tandem with the benchmark indices, 0.4% of uptick that we are seeing for the Nifty Bank. So yes, keeping an eye out on that. Now today what is done well and what was performing well was the broader market. When you look at the Nifty Midcap, 1% gain there, Nifty Smallcap 2 trading with more than 1.5% almost of gains coming in for the Nifty Smallcap side. Let's pull up sectors, right? We'll talk about Nifty Media first. That's the one we're focusing on. Top sectorial gainer that we have was the Nifty Media, up 2.5%. And in that, let's pull up PVR because that was buzzing in trade after we had seen a good move coming in terms of the collection numbers for the recent release of Kalki movie, which was there over the weekend. First cut of the weekend has been very strong, 300 crore mark. And PVR surely buzzing in trade. Short-term positive, at least coming in for PVR Inox. So yes, that's the buzzer in trade today. Other than that, we had IT companies that were buzzing in trade. So yes, we had those previews started that coming in, and with that, Nifty IT surely among the top sectoral gainers. Whether you look at a TCS, Infosys, Wipro, all of them buzzing in trade. Persistent Systems even on the mid-cap side, we did have, whether you look at a Birlasoft, which managed to hold on to good gains today in trade as well. So yes, Wipro, double upgrade payment from CLSA, keeping an eye out on Wipro specifically after this double upgrade, target price of 607. So good move that we specifically saw for Wipro as well. Let's move on, talk about Walk Hard because that was locked in upper circuit today. 20% is the upper circuit that we saw for the thing, the stock, and it was, when you look at it in terms of price band change, that came in 5% to 20%, and now the stock is locked in upper circuit. Other than that, obviously the news flow that came in on Friday was in terms of the claims for the breakthrough drug resistant for a cancer patient, which is working out well for the company, a good market that they could capture in there. And Walk Hard, no mention about that, surely holding on to very, very strong gains over there. JSW Infra, that's another one we should be focusing on the back of a news flow. JSW Infra today was holding on to good gains. Other than that, on the back of auto wins, we had seen Garden Reach, as well as when you look at it in terms of NCC, we're keeping an eye out on both these stocks as well. On the back of order inflows today closing, the stock closing the day on a very strong footing over there. A lot of Q1 updates that came in today. So whether you look at it as a REC that managed to hold on to good gains, we had KBB, that's Karur Vysya Bank, decent gains that it saw in, but yes, gave off those gains. But that's how we'll be closing the day today. Advance decline ratio today clearly in the favor of advances versus declines, and a lot of positive moves, specifically for the IT as well, the media names.
If you like this video, then like, share and subscribe to ET Now.